Well, good morning, everybody. Sorry about the little hiccups we had there. For some reason, it wouldn't let me in the front door. Don't know why, so I had to kick it in. Here we are anyway, Fed Day. Welcome to the folks from Eightcap. Good to see you again. Right, where should we start with this one? Right, go over some of the points from yesterday and stuff we've had out overnight. A few bits and pieces coming out. First, just a quick look at yesterday's data, some of the data in the afternoon, particularly from the US. Not such good news out. Let me get on the right page. We had some housing data. We got the house price data for May, a little bit lagging here. Prices still holding up fairly well across the two different metrics there, the FH, FA and K-Shiller house price indexes or indices. Some there. As you can see from the year-on-year numbers, but still running at elevated levels. As I've been repeating, this is like the final domino in the housing market. If prices start tumbling, then it really does point to bigger problems than what we're seeing already. We did get new home sales out, which were down 8.1%, dropping to 590,000, a big miss there of 660. So again, we're seeing activity slowing there, but as I say, we've still got this disparity with prices. So until we start seeing prices tumbling, that'll really give a indication that the housing market is suffering. Some of the other little bits and pieces came out. Some of the regional manufacturing and services surveys came out, again showing negativity in those as well. We did also get the US consumer confidence. Perhaps no surprise that it missed as well, down on last month. We also saw a dip in the inflation expectations. It was 8% last month. It got revised to 7.9% as well. It came in at 7.6%, if I recall correctly. So something for the Fed to keep an eye on there, that expectations have now started dropping in both the Michigan survey, and we get the final number from that on Friday, and the Conference Board consumer confidence data as well. So the numbers pretty much across the board in that survey all heading south. No real big panic in the market about it. You know, part of this recession pricing that we saw a few weeks ago, the market is getting its head around the fact that a recession is possibly coming, or data is weakening. I mean, we're seeing weaker data starting to happen across the board. So the shock factor of that, I think, is pretty much, I wouldn't call it 100% baked in, but the market is now leaning that way, that we're going to start seeing softer economies in the US and around the other majors as well. So that's all going to play into the Fed, and we'll speak about that in a moment. Some of the other things that came out overnight, we had Aussie CPI. Year on year higher, but on the quarter lower. So a bit of a mixed number there. In its entirety, the quarter on quarter number dropping is probably more of something of note for the RBA. It's not something that will really change their current path, but if we start to see a trend in that, then we're going to start to see people making different changes to expectations there. But as you can see from some of the more core numbers, if you like, or the adjusted numbers, they were all pretty much higher as well on the year-on-year numbers. So again, nothing really there to change the RBA stance. Some of the other bits and pieces of data you can see there, Chinese industrial profit, small rise there versus last month. Industrial profits year to date matching the previous. Japan had a little bit of softness in some of its data, leading index, the coincidence indicator. Again, pretty minor moves, and we saw yesterday that they'd actually raised their, or the government have raised their view of the economy to a little bit more beat, but we're going to be seeing differences in the data coming through there. German consumer confidence, or climate as they call it, dipping further again, another number worse than expectations and far worse than last month. And we're seeing this pretty much across the board. French consumer confidence, Italian consumer confidence, Swiss, every piece of data we seem to get these days is showing softer numbers. And this is the theme that's coming through right now. And that's all going to play into what we see from the central banks. Before we get into the prices and what it all means, just some of the other headlines that were out that might be significant. Biden apparently is speaking to China Z tomorrow. Various subjects obviously on the table. There was a comments to say that he's yet to make any real decision on tariffs. So that may be something that comes up in the conversation. Obviously, the hot topic may be Pelosi's planned trip to Taiwan. It was announced about an hour or so ago that she's going to Japan as well for a little visit. Just some other headlines. Twitter, they said that they significantly slowed hiring in Q2. That's following some of the other big companies like Tesla, who they're going to slow hiring. What's significant about that is that hiring is going to slow, not necessarily they're going to cut the workforce. And that distinction is going to be something we need to look at when we're looking at further jobs numbers to come. Is it a case that we see things like the NFP slowing down? We're seeing the employment metrics in things like the PMIs and the ISMs all a bit lower. That doesn't mean that people are starting to get sacked. It means that just people may not be hiring as quickly as they may be. So if we're going to be watching the jobs market as sort of the last pillar of the economy that's standing up to rate hikes, we may have to be prepared to see some falling numbers. I don't think we'll see any negatives just yet, but if we start seeing lower numbers, getting down to sort of sub 200, then we're potentially going to start heading towards seeing negative numbers. So it's going to all be about the trend. I'm not saying we won't ever see a negative number in the NFP. We know it can be an absolute lottery. But that's something we need to keep watching from these jobs numbers and seeing how the picture changes month to month. Nothing else really that I've got. We've got in China also, they locked down Wuhan, the infamous Wuhan region where everything started. They've gone back into lockdown, some 900,000, 1 million people all locked down again. The Nord Stream stuff is ongoing. Everyone's a pipeline expert these days. We've been looking at it in the room. Not running as high a capacity as it has been. We're said to be running at about 20% capacity. Uniper saying they're only getting 20% of their nominations, i.e. what they've booked to come through. So still we're getting these headlines ping-ponging around. And, just as I'm sitting here, we got the Kremlin coming out and saying Gazprom remains a reliable supplier but cannot guarantee supplies if foreign equipment cannot be serviced due to sanctions. So the game playing is continuing there. Gazprom using it as an excuse. Basically, the squeeze is coming on, and countries, particularly in Europe, are getting worried that they're not going to be able to stock up enough for winter. That's playing into the euro, and we're seeing that coming in. So that's ongoing. Belated good morning to Kay and Stel. You guys got anything you want to add to the headline front?
Yeah, morning.
Yeah. No, I was just going to say that the GfK German consumer climate number is the worst on record, if I'm not mistaken, and we weren't even close to these levels in 2008. Just to put it in perspective, so it's definitely not looking good on the front, especially in Europe. And I think you very correctly said, Ryan, the main worry is that we're, the summer is almost over, and what happens with energy going forward after the summer? Because at the moment we don't need much heating, but we will do after August, September. So. Yeah. It's Russia is definitely in a position of power, no matter how people try to spin it the other way. And I don't know how Europe is going to turn around this issue of dependence, near total dependence on oil and gas on Russia and Ukraine. They could turn to nuclear, but obviously the Germans don't want that. And also, it's not something you can switch on from one day to the next. So it's a tricky one, because if there's no kind of a solution or compromise, we're going to be facing a cold winter here in Europe.
Yeah. As I've been getting in the room, I'm going camping next week, and I was going to use those little gas cartridge cans for my cooker, but I've ordered a 10 kilo gas bottle just in case there's any problems over the winter. I'm going to have that in the gas to be able to make me beans on toast. So I'm stocked up, and I'll sell some to you if you get short, mate. Don't worry about that. I'll stick it in the post. Kay, do you want to add anything to the headlines and what we've had this morning?
Yeah, in Greece they won't need your gas can. I think in Greece it's always like at least 20 degrees. No, the only thing that I saw in addition to what we've been talking about is S&P yesterday adjusted Italy's rating a bit from positive to stable. And that, of course, has been putting upward pressure on the Italian spreads again, which are, again, at 250 basis points above the 10-year, above the German ones, which is an additional drag on the euro. For the rest, is just basic, how should I say, adjusting positions ahead of the FOMC and ahead of the GDP tomorrow, and it's going to be a hot end of the week, because it's end of month as well. So we have to take that into account. Today we are trading value date end of month, so we might have a bit of US corporate activity, and then the next few fixings we'll see. Perhaps the other way, things go the other way around, as the models are suggesting. So, it's going. Do
you want to give a quick explainer on what that means, a value date end of month, and what happens at these fixes?
Yeah, so there's basically two things going on. There's basically two things. So the first one is that depending on mainly equity moves and to a lesser degree, but still. Of its own importance, the bond moves, the currency neutral investors need to adjust their FX derived from all these moves. So that's been modeled for years and years now, and then the models come up with an expected volume to be done, which is for this month. Seeing the relative rise of the US and especially the S&P, which is the biggest, the highest volume in this index, it said that the flows, the rebalancing flow, should be negative dollars. On the other side, you have the value date end of month, where US corporates usually go shopping to repatriate some of their foreign profits and receivables, and they repatriate some of it into dollars, which usually sees a bit of activity to buy dollars on the end of month value date. Now we have seen quite a bit of dollar buying at some stage yesterday, which has then been reversed, especially in things like cable. But we have seen a bit of dollar buying yesterday, so I wonder if they didn't go a bit early yesterday, and we'll have to wait and see what happens in this afternoon's fixings. But that basically is what the end of month flows mean, or where they come from.
Yeah, exactly. And just to reiterate that what Kay said, so people who are, as you said, currency neutral in investment. So as investments rise and fall, there's obviously profits to be derived, and that increases the FX positions naturally in accounts. And what some firms tend to do is at the end of the month, they tot it all up, rebalance the FX back to neutral, any changes. And as Kay says, what these guys do at the banks is try and model based on the market moves what may happen at the end of month at these fixings. They can be a little bit wishy-washy these models and stuff. I've just put a couple there that we've had note of in our room. You can see on the screen there from Barclays and Morgan Stanley. It's not something you hang your hat on, but around the fixed times, if you do start seeing some significant moves in the dollar, and particularly over the big periods like we've just had, which was end of month, end of quarter, end of half year, we got some significant moves, and today is one of the important days. So look around the 4 o'clock mark UK time, which is one of probably the biggest fix period of the whole day. But as Case mentioned, firms do it a bit more dynamically these days. So you can see these little moves into an hour number at the top of an hour. You might see the dollar move, 10, 20, 30 pips just out the blue, or another currency move. And, some of these you can pin down fixed moves. But it's one of these things that's an important part of what we look at and what we trade and see regarding the price action. So it can be significant at times. Right, should we get stuck into the Fed stuff then? I don't think there's not much to go over. Hold on, I think it's your chat on the screen. Is everything all right in my sound and stuff? I'm just looking at what Nick's typing.
Yeah.
You sound fine.
Yeah,
cool. Okay, I don't want to repeat too much about the FOMC today. We're at that point where all the talking is done. My view is they're going to go the 75. That's not going to be the important part. The important part is what we get in the message after regarding the path for hikes. Are they going to stay on the same path? Are they going to look to scale it back a bit in the months ahead? Are they going to pause hikes? Are they going to see a lower terminal rate than the current 3.5-4% they're looking at? Is the neutral rate going to be lower than the sort of 2.5% we're going to be at potentially after this rate hike? So that is going to be the main move for me, is the message we get in the statement about this meeting. So for me, it's just a question now of picking the numbers on my chart, which ones I'm happy to trade, which ones I'm not happy to trade. And that's what I tend to do. I go through the charts. I look at some of the pairs that I want to watch over something like the FOMC. And it's just a question of drawing my battle lines. Euro dollar, we've been saying this for a while, 103.40, 60, parity down below. Same as it was for the ECB. I may look at something closer to this, 100, 60s, 70s area, which is a bit of a support area before. We've obviously got this resistance up in the mid 102s up to that fib level there. So there are some key areas, but when we've got events that have these big potential volatility spikes, I tend to just look a bit wider. And I'll be looking at these areas here as potential stretch points. If the news is big enough, but we can't break those, that'll give me some conviction to maybe try a bit of a fade. Conversely, if we break, is it going to be a proper break? I'll look for confirmation of that break by a retest of the levels. But no real difference to the ECB. I have my lines. Those are the ones I'll trade, and I'll largely ignore whatever happens in between that. And the same can be said for dollar yen, and I'll let the other guys come in shortly and have a look at their thoughts. For me, I'm more a rally seller in this one. I want to be on the shorter side rather than the long side for now. I really can't see anything that makes the Fed more hawkish than they are. That would be a big surprise to me. If they are more hawkish, if they start putting 100 pips on the table, that would be a big surprise. But otherwise, I'm potentially looking at selling any decent rallies in this one. Obviously, if I was choosy, I'd like a move up to the high 138s, but I think we're a bit far away to see that. So I may have to set my sights a little lower down. We are finding a bit of resistance in this 137.15 area at the moment. It was a prior breakdown area. But if we do get a move up, maybe into up towards 138, that'll be somewhere where I'll potentially look for a short, maybe to sit on for a while and see how things progress from there. You guys, you got anything in these two pairs you want to throw into the mix?
Not really. We've said it before. I agree with you on the Fed. I think there's no reason for them to do anything else other than 75. They don't want to surprise the market. 100, I don't see why they would do 100. 50 again, I don't see why they would change their path this early. They will eventually, but this early, no, I don't see anything. The equity market is still kind of behaving, and inflation is still high. So I think they're going to keep going with 75s. They're not going to give us anything new or any kind of surprise. And frankly, if I was the Fed chairman, I'd be very happy seeing how the market is reacting to the Fed taking rates today, basically to 2.5%. And if you had asked me before when we were at zero, what happens when rates go 2.5%, I would have said, probably a little bit of mayhem, but it's been gradual and it's been steady. And as long as this remains, I don't see why the Fed is going to take the foot off the accelerator. So,
I agree.
Regarding the euro, we've said it before. The lows are, the bottom end of the range is pretty straightforward. It's really the lows at parity-ish. And then above, we have 102.8 and 103.5. It's as simple as that. But, I'm not doing anything ahead of the Fed. The thing I did say yesterday on the morning edge, and I don't know if anybody was there and followed, 10-year US at 272. I said, look, I think it's a really great risk-reward short here. I know we have the Fed today, but it's very clean where the breakout is, and it's above where the breakdown is. It's below the 270 lows, and we're already 7-8 basis points higher, and we're at 280 now. So it looked pretty good at the time. And as with every trade, as long as you know where your stop is and you adhere to it, I really like these kind of 1 to 3, 1 to 4, 1 to 5 risk reward trades. So, but again, we have the Fed today, so anything could happen. But for anybody who's followed that, you can put your stop at break even and just run it. Anyway.
Yeah. No, I agree with that. I mean, the significant thing for me from bonds is that we're not keeping the gains. I mean, we had these highs in June, and the Fed are hiking away, and yet yields are not moving higher. And that's I think it's a big factor of the market getting over the Fed pricing. And we're pricing when are they going to start lowering rates? When are they going to hit the topping rates? And how much of a soft landing or crash landing this is going to be? And that's, I think, is what's being reflected in rates right now. Because really, with the Fed hitting rates of 2.5%, normally we'd be way above 3% and sailing pretty. But this is the short termism, if you like, in markets these days. We don't get cycles. A hike cycle used to last 2-3 years, and it would be 3, 4, 5 years after that before rates might change. Now hike cycles in market terms are bi-weekly. We're already trading 2023, 2024, and rates coming back down again. So that's going to be, again, as Stel says, watching bonds over the FOMC is going to be important to see what they do here. If we get another rally in yields and they don't hold, that's going to take the shine off any dollar gains that have been following. Kay, what about you? Yields and the yen?
Well, first of all, on the FOMC, I think 75 is pretty much baked in, and then there might be hints in the statement at something, but the press conference will be the most important, in my opinion, because Powell will be questions about the rate path. There are some possibilities. My base case is that they are still on autopilot. Yes, we have seen a bit of weakening data coming in now, but that's completely in line with what Powell said. There may be some pain to be taken, and actually, and where I agree with Stel, there isn't yet real pain taken because the equity markets are holding up pretty well, and hence the wealth, let's say the global wealth portfolio is still pretty much intact. We were thinking and fearing, Estelle was saying, moving from 0 to 2.5 or possibly higher later, that it may put S&P back towards 3,400, and yet we are closer to 4,000 still, which is an achievement. But the thing is, just one second. The thing is, yeah, now I lost my ID because Nick was asking something. The thing is, where in the press it may get interesting to me is any hint of Powell saying what may happen later, because we can't forget it's not a monthly meeting. We are now, it's 27th of July. We are going to have to wait for 2 full months until 21st of September for the next FOMC meeting. So I do think there is going to be an importance here about how the communication is going to be done. If ever he says that, because the next one is in September we doubled the QT, right? And so far the QT, which has been running now, hasn't had that much of an effect on the real balance sheet. It has affected a little bit, but in September it really should kick off at 95 billion a month, which is going to have an effect on the balance sheet. Is he going to hint at something where he may say QT will take over from bigger hikes? It is possible, but it's one of the possibilities. I'm just trying to enumerate the possibilities of what we could possibly have. Will he go more data dependent? It should be. There should be some data dependency in the statement, which is always there. But he may also talk about we are closer now to neutral, because 2.5% was touted by a lot of members, saying that may be the neutral rate. Okay, we know from all of them now that they are willing to overshoot due to inflation for as long as the data, like unemployment and other stuff, is still holding up, and they will keep an eye on the equity markets as well. But there are a few questions that can be asked during this meeting, just because it is a meeting which is where there's not one next month, but only 2 months later. So I expect there to be some explanation and deriving from that moves. So for the euro, before I'll take over my stuff a bit later on, but just to come back on what you were saying, yeah, the euro, I have a bit of a level just below 101, but then the big lines is parity, 102, 70, 80, and 103.5 right now. I doubt if they are on autopilot. I doubt that we will break out of it. Wouldn't it be that I'm still pretty negative euro due to this this whole energy situation, and we have seen as well the data starting to come down a little bit, and I repeat, it was a front loading 50 bps by the ECB, and to me, and in the end, a relatively negative 50 bps comparable to the size of the hike. And just to reply quickly to Stephen Oliveira, what is the QT? It's quantitative tightening. It's what they have been putting in place over the last meeting. So they are reducing and reversing their bond and asset purchases by 47.5 billion per month right now, and they're doubling it to 95 in September. So yeah, Mike, I'll come to Dolly in a minute. Do you want to look at stuff, or should I
take them now, mate?
Sorry?
Do you want to take them now, mate? Take the
yeah,
chart?
I'll grab them now. Just hold on a sec.
Yeah, I'll do me stopping.
Right.
I mean, it's funny, really, because Powell's going to be in a position where he has to talk about hurting the economy in a way that doesn't hurt the economy further. It's a crazy position to be in, and the market, that's what the market's going to be talking about. They're going to talk about, well, probably the presser people, the journos, are going to be asking, you know, we saw a big contraction in services. Does that mean you're going to have to ease up on your hike path? All these questions are going to come in. But just while Kate gets it up, also what it means is we are seeing a bit of summer trading coming in where we're seeing quiet periods, but this big gap between Fed meetings, if we get some really shocking data and there's no Fed heads to come out and calm nerves, we are potentially going to still see some very volatile moves during these summer weeks, because there's going to be lower liquidity. So if we get a shocking NFP next week after the Fed have all gone on their holidays, you know, it's really got the potential to be very volatile in the markets, because there's going to be a lot of questioning over the next 2 months. Anyway, Kate, all yours, mate.
Okay. So to come to the rates, so the euro dollar, first of all, we are here. It's quite simple and straightforward. This 102.70.80. 101.20 was a level, but we've traded already below, been watered down a little bit. I've got the next one, which is just around the 101, really 101.95 figure. Those are the nearest one that I'm watching, but clearly we are looking at parity again here. This trend line and the 99. The prior low. The one I want to show again, this longer term one, which I've been looking at, and I have to go even to the weekly. To me, this one here, this is going to, I need to clean this one up. Just hold on a little sec. Okay, so this one here, this here, it's 99 figure. This is the whole move from 2000 to 2008. And this 99, the figure is 78.6. I really think this is the battle where the battle for parity is won or lost. So we've seen the dip below. We've seen the rebound, subsequent rebound, which a lot of us were expecting, or at least taking it into account that was a possibility. But to me, 99, the figure, is where the battle for parity is won or lost for the more medium-term traders. And I'm not sure whether we are going to see that one today. It's possible that with the Fed on autopilot, that the market is getting ready for whether it be month end, whether it be a bit of summer trading, and we might not visit those lows. And in which case, I reckon we are going to be in a range for a while. But as I said, I'm not a big fan of the euro right now for the gas and other situations. A quick look at the cable. I think we have a couple of interesting levels here. So the pre-level was around here, 120.80, 85, 80.90. And then I think we are in a little bit of a wedge here with the top side around 121.10.20. And to me, there's still this, I'm still respecting this 121.55.65, which I've always been watching this as a barometer for the relative strength of the cable, just cable, sterling versus dollar, not really crosses and stuff. But I really think this is an important one, and we are gradually closing in on that one. If we go back above and close above, why not have a retest of the higher trend line and perhaps even 123? Who knows? If in turn we start to get back below this yesterday's trend line, call it 119.70, 75.90. It might look a bit in danger here for a move back down to probably 119, the figure. If and buts, we have to get through the FOMC first. Dollar yen, it's been a request by Mike. Let me put it on a bit wider. So to me, we're still in a more medium term. It's still bullish, right? On the longer term, it's still bullish. And I mean, there's no way around this. This kind of picture is in the long term still bullish. But with the yields having come off this much so far, that will be one of the cleanest probably dollars versus yield trading. If those US 10s, and especially the 10s, if the US 10s start to break below what the levels that Stella already mentioned this morning, if those yields start to break below those 272, 275, we have to know that the biggest investment of Japanese accounts into US assets is via those 10 years. The whales, GPIF, the big insurance companies. Japan has some of the biggest insurance companies in the world. And pension companies. They are really, that's their main vehicle. Although they switched some of it up to the 20 years because they had a better return over the past year or so. The main concern for them, for their medium-term investments, are the 10-year and the 10-year dollars. Okay, so that is one that people should keep in mind. So that's going to be, in my opinion, the cleanest trade if there's a big move on the yields. So to the downside, I will say this 136.10. 136 figure 10 is going to be the first decent level to watch for, and then below there 135 half, three quarters, call it, and that's going to be a bit of a zone where we need to pay attention to. If we start to break below this zone and hold below call it 135.40 or so, 40.45, we might have a chance of a deeper correction. And I'm saying that especially, I can't for the time being be long yen for more than a couple of sessions because of the big interest rate differential still, and Kuroda standing pat, the Bank of Japan standing pat despite warnings of the Ministry of Finance. But if we start to really break below this zone here, 130, call it 135, 40, 50, then and hold below, we really have a chance of moving lower. On the other hand, if the Fed is on autopilot, if Powell doesn't signal that they go more data dependent, meaning that he has seen this and past weeks slowing down of the economic data, and we get to start to break back above 137, call it figure 20. There's a chance we're going back up to 138 for a starter, and then we will see how strong this channel is. That's where we are going to measure how strong this channel is. If we start to break above 138 and hold, then I think we're back to the prior highs. But it might not all happen today. It might be food for a couple of sessions. But I would keep those two levels in mind, and we're hovering right in the middle of them now. So on the tight, I would say 136, and then watch this 130, 35, 40, 40, 60 zone. And on the tight, on the high, 137 figure a quarter, and then the bigger one around 138. That for the dollar yen and for the FOMC. I'm not planning to trade much of dollar Canada, for instance, or Dolomix, for instance, just because of their proximity to the US. Those things I rather trade via crosses right here and now. To come back on those, I'm still, and I re-entered just very, very small this morning, short Euro Canada, because of the gas situation, and because Canada is one, together with Norway, one of the beneficiaries of possible EU looking for other avenues to get their energy from. So we have a bit of a level here at 130.30. It's been a bit below, rebounded, but for the moment we can't even get above 133.25. I think the real zone here for the resistance, the first resistance zone, I must say, is around 131. If we close the day below 130, I think there's 130.30. I think there's a fair chance we are going back to the prior lows, but we'll have to see once those month-end flows kick in, once the FOMC is behind us. If ever we start to move up again, I think then the next level is going to be around 131.75. The big zone still being, but that's for the more longer term, the 133.90 figure. But I don't think that with the situation in Europe right now, it's fair to assume that we can even make it back up there to 134. On the Mexican side, then, quick look at the Dolomix. We are back on this trend line around in the mid 2030s. Keep an eye on it for any month end. I don't know if there's a lot of month end to do in Mexico, but there was an interesting article yesterday in Bloomberg, which Craig in our room highlighted, saying that the Mexico's super peso shocks traders who were betting on a wipeout. I'm putting the link up in the chat, showing the strength, which was a little bit unexpected on the Mexican peso side. I'm not sure whether they were hinting at really Dolomix, but partially probably. But I think a lot has to do with exactly what the article says, is that the proximity of the US for Mexico is still extremely important. And if the US is on their long-term build back home and buy American, build American path, Mex should be seen its proximity and seen its manufacturing capacities and exports to the US, maybe a beneficiary here. Will it be on the Dolomix? I'll leave that in the middle for now, but I think this one, we're still on our way. If you look at all these directions of channels and of actually just price action, I think we are on our way back to 20 at some stage. I mean, that's anyway how I keep my positioning right now. It's relatively small. I will see once the whole blah blah is over today if we are above or below 2080, and even then I might already press a few buttons and increase my positions again, because I didn't get what I wanted back at 2120s. What else? Yeah, dollar CNH, it's neutral. I even didn't update my chart anymore, but we know we are trading somewhere in between 672 and 6 here, 78.5, 79. It's capped for now. It's we are a little bit listless, but I'm keeping just a base. I've been trading it around, but I'm keeping a base long for after the whole thing. I don't know if next month is going to be a big mover, but PBOC, they continue to inject liquidity. They are still in lockdowns. The overnight repo rate dropped below 1% again, first time since January 2021. I'm still mildly negative for now on the CNH, but I'm keeping an open mind. See if we may get an opportunity to buy back, whether it be around 672.5 or 672-ish. Keeping my options a bit open here. If we break above 79.5, I think we might be quickly back up trading 684. And the last one, there was one other one I wanted to have a look at. No, I think that's it. Quick look on the metals, which I traditionally do. Stuck in the middle. Is stuck in the middle with you. I don't see much to do in gold. Let's see how the yields evolve. Today, gold has been a yield play. It has responded well to the decline in yields, and now we are waiting for the next stuff to happen. Silver, same.
Just
same.
on the gold, Kate, I think we're in striking distance, good striking distance of that those lows, 1680s, 75s, 80s, is it?
Yeah, but we have rebounded pretty strongly from them.
Yeah, that might be one to look at over the Fed.
Absolutely.
We're in another one of those levels. If we test it but can't break it, that may be a good signal for a fade.
It's a quadruple low. We have to respect that. As long as this quadruple low holds, we may still be in our long-term move up from starting from 2015. This could still be one big bull flag, but we have to hold here. If we don't, there could be $100 below there. But that is yields going to determine that. And then on silver, the thing is, we are now in another triangle. Okay, we're trying to break out, but we're breaking out horizontally. So I'm not sure I want to look for much more. To really add to my silver longs, I'm going to need to see the global economy hold up, because it's as I've been many times repeating now, it is an industrial metal. It is partially driven by interest rates, but to me, if it wants to outperform gold, for instance, we need the global economy to start to hold up and not showing too many more de facto weakening. We can have a bit of a adjustment in the data. That's part and parcel of the economy, especially that the economic cycles have been so much accelerated since the pandemic. But I will need to see economic data hold up to really add to my positions here. And if I see that happen, then I'm completely with Stelios. This could be a maybe not a lifetime, but a generational opportunity. If not, I think there may be a chance to get back down to 17 regarding this congestion. This congestion area, the traffic zone, I call them, it is a possibility, but I'm for sure, if due to more economic weakness, but without really falling out of bed, if we get down there, then I will load my truck up on silver for sure. And with that, I hand it back over to you.
Cool. Cheers, mate. Grab that, and we should be okay on the other one. There we go. Yeah, so I mean, just to reiterate what I've been saying about trading the FOMC. I tend not to take positions going into it. I tend not to take a side going into these things, and I know a lot of traders have I think the Fed are going to do this, so I'm going to buy or sell this, that, and whatever, and see what happens. For me, that's more of a gamble than trading, because we don't know the outcome. And as I mentioned, it's very hard these days to be able to read a headline that pops up on whatever screen you're watching and to get in a trade before the market's gone. I used to be able to do that when I was on the live floor, and it was me versus other humans. But it's us versus machines now, and we're always going to be well behind on grabbing an instant decision. So I've had to shift the way I trade these things and look at levels like I mentioned at the start of the show. Go over your charts, look at something like gold where you've got a really big, huge level down at that 1670s, 80s. And that's the level where the price has got to ask a question. If there's big news, can it break this level? If it can't break the level, it's only going to go the opposite way. If it does break the level, can it hold the break? So that's where I look for my opportunities really over these events. And I'm looking at dollar CAD here, and those who have been in the room, I've been jobbing this off this support area, and I mentioned this yesterday. I've had a couple of attempts now. I bought down at 128.20, my lowest entry. The highest I knocked out is 128.20. The highest I've knocked out yesterday was 128.88. My stop is now at my highest entry, 43. I may close this up into the Fed. It depends where the price is. If the price is up above 129 into the Fed, I may leave it on because I've got a bit of margin to play with. But if we're in this area now and I haven't been stopped, I'm going to take my money off the table and come back and look at it after, see what happens. It could spike to 129.5 higher. It could dip to 127 over the Fed. That's the risk possibilities that this brings. And I'm, as a trader, I want to know what the risk is. I don't want to know what the profits are. I want to know what the risk is. Where can I lose money? So I'm likely to take this trade off if I've not been knocked out of it beforehand. Look at it after, see if the levels then re-establish themselves and where it wants to be. But for now, 129 shown up again. It's been a bit on off, but then after a bit of time, it's shown itself up. And the loonie is one that can play really nicely with the levels, as it has been here. It's been holding the support areas, holding the resistance areas. And if you're just jobbing around, that's good moves. That's good markets for you. You don't want to see little spikes through to stop you out, and then it all reverses and a spike through there and stops you out. So the loonie can be a better pair to play than the others. Kay mentioned euro dollar support was 101.20, but we went through that, and it's not clean, but the loonie can be clean. Euro sterling is another one Lorena asked about, and then again another one I'm trading and looking at. I've been bitching because I missed this bounce here and this long into here, so I've added to my position. I've got a core long running, but I've added a position. Bit of a chase yesterday, 84.22, because I missed this move down here, being a dick for a pip. I then had a bid at 05 that went unfilled overnight, even though the low got down to 047 or something. I have now been filled on that bid, but I'm in that position. The price action down here, we're not bouncing very far, and I'm beginning to wonder. We've had the break under, little move under the big figure. I'm wondering now if I want the position at all, because we just keep coming back to this level, and as I say, the bounces are pretty weak. There's every chance we get a shove through there. So this one, as I say, I've got my core long position, which I think I'm going to look to do something this week as I head to my holidays as well. As I've mentioned, I'm bleeding the carry to the broker, so I may reduce the position right down, keep a little bit on, and look to get back into things after I get back from my holidays. But in the meantime, I'm going to see if this one holds this support area, and if it does, then I'll look to take some off the table if we get a move back up, sort of 84.5, maybe up to the 85s. But look to also keep a little bit to put in the bottom drawer for my core position. But if we do break here, we do have some other levels below. 83, 80, 85 is a bit of a prior historical level. It's a bit of a zone really from the 67s, 70s to 80, 85s. A bit similar to this zone we've got here, 84, 84, 20. So these are the little traffic spots that, as Kay mentioned, that's what we like to call them. It's never potentially one line, one level. It's a bit of a zone, a bit of an area. But if we get a break below this 60s area, it's going to put some pressure on this pair, and we could see it heading back towards the low 83s, maybe into the 82s again. On the top side, pretty clear. Long term, 86 and obviously up into the 87s are the big number up here. I think this pair is on the soft side because of these gas worries, and as we've been mentioning the Nord Stream stuff, it really is becoming a bit of a snowball worry for the Eurozone, and that's going to be a big worry for the euro. It's potentially going to mean that the Eurozone slows down faster. You know, things like German factories have to go into shutdown because they have to close up because they've been limited on their gas use and fuel use. You know, that's going to impact activity even more. It's going to become a bit of a doom loop. So we have to see what happens from there. Still, there's no reason really why you would buy the euro. I'm only buying it here because I want to play the divergence between the ECB and Bank of England. But I'll recognise if the trade's not working, or if it's not working at this particular point, and maybe I'll reduce my risk on it. So that's my thought on those couple of pairs. I don't know if let's check if any other questions in there that we've missed. All trade. Yeah,
there was a question about natural gas, but we don't really cover that, unfortunately.
Yeah, from Alexander. Yeah, I mentioned it.
Oh, you mentioned it? Okay. The thing is, on natural gas, you can trade the US one, but if you want to look at it for dollar moves versus euro, for instance, it's not going to help you because there's the European gas prices are completely out of kilter compared to the US ones. So I'm rather keeping an eye on those European ones, which are extremely volatile, but who can influence the euro side of things. But for the rest, no specialist in US nat gas, to be fair.
Yeah, exactly. Mike's just said there, but all traders are gamblers in the sense we all make educated guesses when opening a trade. Yeah, you could say trading is gambling. But you're right. It's making that educated guess. You know, we're not picking up a horse program and shutting our eyes and circling our pen on the page and picking a number. All we try to do is try and cover as much of our risk as possible. You know, the reasons why we want to enter a trade and the reasons why we won't want to enter a trade. And if one side wins out over the other, you either make the trade or you don't make the trade. But what we have the ability to do is set our risk, you know, a bit like a gambler, a bit like having a fixed odds bets. You know your risk. If you stick 10 quid on a horse, that's your risk, 10 quid. The same is said here in trading. You know, if you trade properly, you assign your risk, you know your stop level. And from that point, you can relax a bit because you come to terms with your stop. And you're then making an educated trade rather than a gamble. We don't just gamble on trading. I think XYZ is going to do this, that, or the other is gambling. You can have that thought, but then match it off to your risk, match it off to your levels. Okay, I think it's going to do this, but if I'm wrong, where am I going to be wrong and how much am I going to lose being wrong? That's the educated part of it. So anyway, that's us done. I can't see any other questions there. As always, thank you very much for joining us and to the folks at Eightcap. I hope you've enjoyed your stay with us. We are here every day during the week, Mondays to Fridays at this time. So if you want to come and join us again, then please do so. You can find us on the ForexAnalytix website, the links there to sign up to the webinars. Please stay safe over the Fed tonight. I don't want to hear any horror stories tomorrow. If in doubt, stay out, as we like to say. Let the dust settle and pick up the pieces after and the trades after. We'll still be trading again tomorrow, whatever happens tonight. So I wish you luck with your trading. Thanks to Kay, Stel, and everyone else. Good luck, and see you tomorrow for the aftermath.
Have a good day, everybody.